Good morning, Miss. My name is Tan Sokman and I'm DVM Year 3 financial students. Today I'm going to present about the Asian financial crisis. In 1997, the financial market turmoil in the Southeast Asia gave rise to a financial crisis. A crisis has resulted in an economic downturn beyond its previous expectations. Particularly, sharp decline in economic activity was observed in Korea, Malaysia, and Thailand. In January 1997, the Hamburg Steels, which is a large Korean chaebol, collapsed under a 6 billion debt, which is the first bankruptcy of a leading Korean conglomerate in decades. On February 5, 1997, the Thai company, which is a Samprasong, missed its payments on foreign debt. In early March 1997, the Japanese officials announced that the interest rate might be raised because of the depreciating yen. Although this never materialized, the announcements proved to be one of the first signs of the Asian crisis. Continuing on March the 10th, the Thai government said it would buy 3.9 billion in bad property debt from financial institutions, but then reneged on its promise. On March 28th, the Malaysian Central Bank restricted loans to properties and stocks to head off a crisis. The 20% devaluations of the Thailand baht on July 2 has marked the official beginning of the Asian financial crisis. Then it quickly spread to other countries in Southeast Asia and Republic of Korea. The reason why once the Thai baht depreciated, other countries also came under pressure was that the countries were viewed by investors as having similar fundamentals, including the bank system problems and appreciating exchange rate. According to Park and Song, not only common deteriorations in underlying fundamentals contributed to the spillover effects of the Thai crisis, but also creditors' panic played an important role. Altogether, between June 1997 and the end of the year, the average currency devaluations in the 5 East Asian economies, which is Indonesia, Korea, Malaysia, the Philippines, and the Thailand, hardest hit by the crisis was 80%. But other countries in the region also did not avoid growing market pressures. In October 1997, the Taiwanese dollar was devalued. From Taiwan, the crisis spilled over to Hong Kong, Singapore, and Japan. Asset bubbles burst and stock price dropped sharply. So the Asian crisis has begun once again, and even more intensely. The debate about the origins of the crisis and behavior of investors at the one side of the financial turmoil, which did such extraordinary economies with impressive macroeconomic performance and prudent fiscal policies, suffer from such a severe economic collapse, a collapse with the ferocity that nobody foresaw. Next, I'm going to talk about the factors that contributed to the Asian financial crisis. So the first is the asset price bubble. It is relatively easy availability of credit in Asia, helped not only to finance the region's fast growth, but also fuel investment in increasingly poor and risky assets. The lack of the capacity to cope with the rapid expansions of domestic credit translated into stock market bubbles. Usually, as the financial system is liberalized in developing countries, the following assets price cycle is observed. Banks, because of increased demand, extend their loans for the purchase of equity and real estate. The increased lending towards equities and property fuels overall lending, as this type of loan serve bank as a good collateral while its price is rising. In such situation, movement in assets price can affect the health of an entire financial system. As the value of assets is appreciating, both borrowing and lending continue to increase. The competition between financial intermediaries drives the profit margin down just as the risk is higher. Finally, the price bubble bursts when the property price exceeds the future returns from this investment. The timing of the event is, however, unknown due to difficulties in describing the adequate rate of discount and uncertainty about future returns. Next is the collapse of the export growth. The Asian Economic Bond was partly based on the export promotion strategy. The export revenues were growing by an average of 18% a year in dollars terms. But the export growth began to slow down in the mid-1990s and dropped remarkably in 1996. Appreciating exchange rate, which is aggravated by both the strong American dollar and surge capital inflow, has contributed to the lower export growth relatively to the growth from the first half of 1990s and the growth rates of world trade as a whole. The plunge in export growth worsened a current account deficit and limited the ability to service the unhedged short-term debt, thus exacerbating macroeconomic fundamentals. The foreign investor became reluctant to extend new loans because costs of borrowing offshore also went up. At best, the accelerating current account deficit was financed with short-term currency borrowing. By the end of the 1997, short-term liabilities exceeded their holdings of foreign reserve in Thailand, Indonesia, and Korea. The vulnerability of Asian countries to the crisis was growing. Next. Current and capital account problems also are factors that contributed to the financial crisis. The capital inflows to Southeast Asia generate strong upwards pressure not only on exchange rate, but also on domestic demand. Given the size of these inflows and budget surpluses, government was reluctant or it was simply impractical to offset the rise in domestic demand by fiscal contraction. The literature usually considers the current account deficit in excess of 5% of GDP as a warning signal of its sustainability. The threat is even greater when the deficit is financed by hot money that can be easily reversed. Although the current deficits in Southeast Asia exceeded the dangerous level, the recent study stressed the large capital account surpluses as a factor more related to the crisis. It is rather reasonable since it is a capital inflow which creates pressures rather than current account per se. Next, I'm going to talk about the hedging technique that avoid the financial crisis. First is the financial hedging. Hedging is a strategy that tries to limit risk in the financial assets. Popular hedging techniques involve taking offset position in derivatives that correspond to existing positions. Other types of hedges can be constructed via other means like diversifications. An example could be investing in both cyclical and counter-cyclical stocks. In the investment world, investors and managers and the money managers use hedging practices to reduce and control the exposure to risk. In order to appropriately hedge in the investment world, one must use various instruments in a strategic fashion to offset the risk of adverse price movement in the market. The best way to do this is to make another investment in a targeted and controlled way. In the investment space, hedging is both more complex and an imperfect science. For example, gold. You can buy gold because gold can be a hedge during times of inflation as it keeps its value when the dollars fall. Gold is a hedge if you want to protect yourself from the effects of inflation. That's because gold keeps its value when the dollars falls. In other words, if the price of the most thing you buy rises, then so will the price of gold. Next, withdrawing emergency liquidity without exacerbating the crisis. With the time profile of these and other reforms in place as and a size of stress in markets decline, the dismantling of emergency liquidity and official lending support should become a higher priority, especially where these have been focused in the individual institutions. In order to remove the subsidy elements and to restore a level competitive playing field. This should not be rushed and should have a voluntary aspect to avoid exacerbating the crisis. Over time, authorities could consider tightening conditions for such support in order to encourage more recourse to markets. A similar process should be applied to the unbinding of guarantees, which distort risk assessment and competition. This should not be precipitously withdrawn, but as the secondary markets develops to price guarantee efficiently and to the extent that extensions can be avoided, terms and conditions prevailing in the broader market should facilitate adjustment. Where financial institutions are concerned, the ultimate goal of the exit from guarantees is to gravitate towards alignment with a redesigned comprehensive deposit insurance scheme. In conclusion, we have to learn some lessons in the financial crisis as it's not over and it will come back again at the future. So one lessons that many countries learned from the financial crisis was to build up their foreign exchange reserve to hedge against external shocks. Many Asian countries weakened their currencies and adjusted economic structures to create a current account surplus. The surplus can boost their foreign exchange reserve. The Asian financial crisis also raised concerns about the role that a government should play in the market. Supporters of neoliberalism promote free market capitalism. They considered the crisis as a result of government interventions and crony capitalism. The conditions that IMF set within their structural adjustment packages also aim to weaken the relationship between the government and capital market in the affected countries and thus to promote the neoliberal model. This is the end of my presentation and this is the reference. Thank you.